Hi folks, Chuck Gibson from Financial Perspectives with a quick educational video. If a gun was pointed at my head right now, I'd have to say we're likely close to the end of this decline. A normal 20 to 30% decline would be ideal for the markets to reset and provide risk investors the opportunity at some profits. We're presently at the small end of that range, so there's still a possibility for further downside. The economy is slowing, but like corporate profits is okay for now, and especially after this correction, has made stocks more compelling. That being said, and because we're 100% in non-risk assets, I'm looking for a bottoming signal to re-enter. With the fear of missing out on my mind, we cannot lose sight of the fact that we're in a confirmed downtrend. Lower highs and lower lows, combined with volatile swings in price, are the trademark of downtrends. You have to look no further than Dow's 660-point decline on Thursday, followed by Friday's 746 rise. Waiting for my long-term model to signal a standard procedure, but as I pointed out in last week's Charts on the Move video, because of its inherent lag, you have the potential to miss out on a lot of early market gains off of a bottom. With this in mind, I thought I'd put together a video of what I look for to take a re-entry back into the market after a correction. The process is always the same regardless of the investment, but for this example, I'll be using the chart of the S&P 500 index. As you can see in this first 2-year look of the S&P 500, it was in this nice uptrend and broke out to new highs in August. By October, the market had second thoughts. It reversed course and fell back down below that new high breakout. That's an ominous warning sign that the bull market may be over and more downside was probable. 11% to the downside later, it found a temporary bottom in this area. Chopped around for about 6 weeks, but failed twice to escape the consolidation, and eventually succumbed to another bout of strong selling. The bottom for the second thrust of the selling turned out to be on Christmas Eve. Since that time, the index has rallied, but as you can see as I switch to my next chart, is coming up against a couple of very strong areas of resistance. The first one is a place that acted as prior support on the rally higher, and in addition coincides with the 38% Fibonacci retracement level. If that isn't enough to slow or stop the rally, which I don't think it will, the second level here was prior support on the way down, and just so happens to be the 50% Fibonacci level, a typical area for counter-trend rallies to die. It is my expectation that in and around one of these levels, the market will reverse course and fall once again back down to December's lows, and maybe further. Let's take a look at what that might look like. A continuation of a rally higher, some consolidation, and then another flush lower, eventually finding a bottom in this support zone. While I draw straight lines, the market never moves that way, so I don't need to say these arrows are for illustration only. Why do I think this is going to happen? Well, after looking at more than 100,000 charts, this is what normally happens. It has the highest probability to occur. Does it happen every time? No. Bottoms rarely take the form of a V after a double-digit decline, which the current bottom has taken the shape of. The higher probability is for price to retest the prior lows and create a double bottom, or even better yet, a divergent low double bottom. When those occur, they become high probability, low risk entry points when trying to pick bottoms. Sometimes they turn out only to offer short-term profitable trade. Other times they turn out to be the bottom, which is why it is what I am looking for to get back in. Let's talk briefly about the risks for each of those possibilities. The first is if you're waiting for a double bottom to occur, sitting in cash, and it doesn't happen. The risk is the market leaves you behind and you miss out on gains. This, as of now, and because of our 100% cash or equivalent positioning, is our only risk. The second is if you wait for an ideal entry bottom, enter, and the market decides it was only kidding and reverses course and goes lower instead of higher. If you're in cash, obviously there is no risk. On the other hand, if you entered at the bottom, it's clear your losses are going to mirror the markets. A way to mitigate some of those risks are to have a tight exit plan, such as a 2 to 4% stop on the position in case that were to occur. This loss is not devastating and more palatable than the alternative. The last option, you could just buy and hold. But instead of the 2 to 4% loss provided by having that stop in place, you'd end up getting much more. Obviously for me, this is the least attractive outcome. The final risk is a little different. What do you do in the scenario where you enter a position based upon the proper signals and price rallies higher, but eventually stalls after a nominal gain and then reverses course? Over that short-term rally, the position has a profit. what should you do? Do you take your small profit, be pleased you have a gain, and exit the position with a short-term trade? Or do you write it all the way back down where you entered, or lower to guarantee a break even or even a loss? Double bottoms can easily turn into triple or quadruple bottoms, and you don't know what it's going to be until you can look in the rearview mirror. There are never any guarantees, so you have to have a plan for every possibility, and preferably before you enter. I bring all these up so you can see the decisions that have to be made every time you commit investment capital. You're probably thinking by now, to hell with this, let's stay in cash. Sometimes I feel that way too, but it's my job to try and make money, which most of the time is not done by sitting in cash. I hope this helps shed some light on what I'm looking for to re-enter and the current investment risks we're facing. Well, that's it. Thanks for listening, and I hope everyone has a great rest of their weekend.